Welcome to Ben's Market Insights. This is episode 2 of the 3 episodes that we're putting out over the 3 weeks of January. We did last week our macro analysis, and this week we're going to work on the micro analysis. Next week we're going to come out with our asset allocation strategy that comes out of these micro themes, if you like, that we're going to be developing. If you're enjoying this content, please subscribe to our YouTube channel, our podcasts on both Spotify and Apple, and give us a thumbs up. Thank you very much. Now, let's dive in. I think the key themes that we want to really extract and talk further about is around AI capex spend. Just because we've moved from 25 into 26, that calendar change doesn't really change anything around this capex spend. That continues at pace. We're going to talk about the impact of a weak US dollar and lower interest rates. And we're going to talk about the Fed and the Trump trades that come out of that. With that in mind, let's start probably with the biggest theme, which is the AI capex trade. I think one of the first things we're probably going to see is that we'll benefit to some extent from productivity gains that begin to flow. We started to see some of that in 25, but a lot of that was going on in investment. So we didn't really start to see outcomes just yet. We saw a lot of money going in. I think 26 is still about money going in and in excess of $300 to $400 billion worth of capex spend, but we'll start to see some impact on productivity gains. We think 2.5% to 3% upside to productivity in industry and economy this year from AI capex. The other thing that I think is worth keeping in mind is that the Mag 7 is probably going to continue to see acceleration in their earnings as a result of this. And so therefore, the valuations that we think are excessive to market are really not there. And anyhow, if there is a liquidity drive to markets, we're probably going to see that the Mag 7 has to continue to outperform, given that they are some 30 or 35% of the S&P 500 index. It's also worth keeping in mind that when we talk about AI, we're moving inexorably from a point where the large language models have been built and the learning process has been done by the AI models. This year, we're going to start seeing more and more inference. And what does that mean? To a large extent, it means that decision making is going to become part of the AI, if you like, platform. And it's not just about delivering the information required, but actually beginning to be able to use that information to make decisions. So we're going to see a lot more elements of what's known as Agentics in the workflows for businesses, in their supply chains, in CRM and demand, in customer demand environment. All of those things are going to start to look at how AI is going to be able to make some low level at this stage decisions, which would have otherwise been made by humans. That implies an impact on employment. I think employment is going to probably reduce to some extent. So US unemployment levels around 4.5% will probably rise, but that will probably be overshadowed by the benefits of those productivity gains. We'll come back to AI in a moment. Other elements that take advantage of the capex spend from AI is around advertising targeting. So the digital ad companies should benefit significantly from better AI and better pattern recognition and better decision making by the large language models. And what I mean by that is the likes of Google, Meta, Amazon, who are the biggest players in digital advertising, are able to collect much more detailed information on their customers and their customers' habits. Put politics aside, whether that implies privacy issues are unlikely to be disturbed because a lot of this information is anonymized. But what it does mean is that their customers, the brands, are going to have much better information about the target markets thanks to AI. So I think that whilst probably ad budgets will become much smarter and tighter, these group of companies will probably start to see a much bigger impact or much bigger flow of that ad budget to them. The other thing that we're seeing is a significant fight between different types of models. Clearly, in the last 3 months, we saw Google's Gemini beginning to accelerate in usage terms. And I think that that's something that's probably going to continue because they've got the underlying user base, and it's very easy to go through the search models and get access to Gemini and ask the relevant questions. But nonetheless, these LLM models will continue to grow quite strongly. Data centers at this juncture, clearly it's Amazon, it's Google, and it's Azure through Microsoft. Those are the three that dominate in the data center market. Oracle's coming up but very much in the rear view mirror. And the key element I think is to point out here is that 85%, if not more, of these data centers are still driven by CPUs. And so the GPU, LLM-driven, AI-enabled data centers are still a relatively small part of the package, and we'll start to see significantly more capex in that area. So more growth, more capex to come from the data center players. And then, of course, it's the industrials who I think will start to see benefits from further productivity gains and efficiencies being kicking into their businesses. Turning to the inflation trade, as discussed last week, I think it's very important to keep in mind that we are seeing an expansive economy kicking in this first half of the year in the US. That's going to be excessive growth. And I think that that's going to drive inflation higher. If inflation moves higher and rates move lower, that spells potential negative real yields. And if that's the case, we see a weak US dollar. In the world of a weak US dollar, we're more likely to start to see an upward movement in commodities, an upward movement in gold, and of course, global emerging markets are also beneficiaries. And so those assets almost act as a hedge against a weak dollar if you're a non-dollar domiciled investor. I think it's also important to keep in mind what's happening at the Fed. We mentioned last week that 5 of the 7 members of the rate setting committee are probably going to be Trump acolytes by May. That is going to imply that rates will come down more than they should. That is where at the short end of the yield curve is where the Fed controls interest rates. We think that's going to be kept exceptionally low, too low. But at the same time, investors who control the long end of the yield curve are going to get very concerned about inflationary pressure, and that's going to drive up the 10-year yields, creating a much steeper yield curve. And when it's inflation that the investors are worried about, that's commonly known as a bear steepener. In a bear steepener, the margins, or net interest margins of money center banks will expand, so expect the market to do well. And actually at the same time, investment banks should do rather well as well, because this year, around spring, May, we're going to start to see potentially the IPOs of SpaceX and also OpenAI. They're competing with each other to see who's going to be the higher valuation. Both are near $1 trillion each. That's going to draw liquidity out of the marketplace because it has to come from somewhere to invest into those businesses. They're probably going to each raise anywhere between $100 to $200 billion. That's going to come from somewhere, and I think that's going to put potentially some pressure on liquidity. So when that starts to become firmer in terms of timing, probably creates some wobble in the markets, if you like. We talked last week about strong yen as rates are rising in Japan. I think that's going to be good for Japanese equities, so we kind of need to think about that element. The administration trade, which is the way I would call sort of Trump's strategies around domestic institutions and domestic sectors. As mentioned last week, given the need to keep energy prices low, but at the same time keep shale industry in business, I suspect that what we'll see is a relatively stable but range-bound oil price. The beneficiaries are likely to be the oil companies, which are currently the ones that are performing, but more likely to be the oil equipment, service equipment companies like Schlumberger and the sector that is likely to be sent out to the new US empire to rehack and refurbish old wells in places like Venezuela and wherever else. I think it's very important to keep in mind that the crypto and cannabis markets are probably going to continue to see deregulation. which is good for their prices. We talked a few weeks ago about the fact that we think Bitcoin is not a digital gold. It's not a anti or inversely correlated to risk assets. It's very much correlated to risk assets. And so if we think risk assets are going to get higher, probably Bitcoin moves higher as well from current levels, much more in volatile form, because now you can buy it in ETF and fractionalizing the pricing, democratizing the number of people that can buy into it. And I think that creates greater liquidity, but it also creates greater volatility. The cannabis market certainly appears to be deregularized, and I think that's going to bring capital as well into that sector. We think healthcare takes precedence, particularly as we move towards the midterm elections. There will be concerns around pricing on the one hand, but it's also likely that we start to see the benefits, or we're already seeing the benefits of the likes of oral GLP or the obesity drugs, re-stimulating the GLP market. We should see Lilly and the likes of Novo Nordisk doing relatively well in that environment. And of course, productivity gains that will kick in from AI adoption as well. In Europe, there is not really any kind of major sector apart from the luxury sector that in a risk-seeking environment should do relatively well. People's pensions, 401ks, the wealthier investors will see their portfolios improve in that first half. So I suspect the luxury sector, which is really driven by the French market, is likely to perform quite strongly. And I think that also the semiconductor industry, both in US and in Europe, in the form of ASML out of Holland, is probably going to react and perform strongly in that environment as well. And cyclical sectors like semiconductors, given that the inference market requires some 15 times more memory than the LLM models, then I think that we're going to see significantly higher spend and higher activity and higher performance and demand coming from simple aspects like memory chips in the semiconductor space. So that's what we're positive on. We're also going to be really need to talk about what we're negative on. That bear steepener has a very big impact on mortgages, because mortgages are in the US come from the long end, around 10-year, and that's going to be a problem. So housing is not going to do well. China is slowing, so we think that the Chinese domestic plays are not going to do well, particularly if there's action on Taiwan, which I think will result in sanctions, which will slow down the economy still further, but clearly will have a major impact on a global basis. And of course, TSMC is the largest component of the global emerging market index, so it would be incredibly disruptive and a genuine black swan event if China did react this year. But as mentioned last week, I suspect we're going to see weak economy holding China back. But don't expect performance to come from sustainability. Trump is very anti that. And UK domestic names, I suspect, will also not do particularly well, given our view that the UK economy is going to probably underperform. And that, apart from the multinationals, implies weaker performance in UK domestic stocks. I'll leave it there for now. I hope we've put a little bit more color on what we think is going to happen with these micro themes this year. Next week, it's all about asset allocation. Speak then.